The Robotaxi Gamble, a $1.6 trillion bet on empty driver's seats. When no one is behind the wheel, who takes responsibility? One video was enough to shake the stock market. A clip surfaced on Instagram, a black Tesla Model Y, driverless, navigating the streets of Austin, Texas. The driver's seat was empty. He posted from inside, confirming unsupervised testing has begun. Within 24 hours, Tesla stock jumped 3.6% to $475. Market capitalization hit $1.63 trillion. Investors saw what they'd been waiting for, evidence of a future he'd promised for years. But no one asked how many times these cars had already crashed. The announcement came in December 2025. Safety drivers would be removed from the Austin Robotaxis. It was a decision he'd delayed, called close multiple times, but never executed. Now, suddenly, it was happening. The vehicles would operate completely autonomous, no human backup, no steering wheel to grab in emergencies. Market analysts called it transformative. Critics called it reckless. What neither group fully understood was the calculation behind the timing. He'd been watching Waymo's numbers closely. Their fleet had reached 250,000 fully autonomous paid rides per week, operating in multiple cities with a safety record approaching human drivers. They were moving faster than expected, expanding into Miami, Washington, D.C., and Dallas. The competitive pressure was mounting. Tesla's advantage had always been scale. Over 1 million vehicles on the road, each feeding data back to improve the autonomous system. A self-reinforcing loop. More miles driven meant better AI, which enabled more autonomous operation, generating more data. Waymo had better sensors and a proven safety record. Tesla had volume and velocity. But volume and velocity meant nothing if the technology wasn't ready. The decision to remove safety drivers wasn't based on perfection, it was based on acceptable risk. Internal projections showed the path to profitability required rapid scaling. Each robotaxi was projected to generate $67,000 in net profit during its first operational year. By year 5, that figure would climb to $94,000 per vehicle. The Austin fleet alone, scaled to 500 vehicles by year-end, could produce $33.5 million in annual profit. Multiply that across every major city. Morgan Stanley projected 1 million robotaxis on the road by 2035, generating annual revenues exceeding $100 billion. ARK Invest went further, suggesting robotaxi operations could represent 90% of Tesla's enterprise value by 2029, capturing significant share of a projected $10 trillion global market. These weren't predictions, these were the foundations of Tesla's current valuation. At 260 times estimated 2025 earnings, Tesla traded at valuations that made no sense as a car company. Traditional automakers traded at 7 to 12 times earnings. Even AI startups commanded multiples of 30 to 44 times revenue. Tesla's stock price wasn't based on vehicle sales. It was based on an AI-driven future where transportation became a subscription service, where cars operated 20 hours a day, generating recurring revenue, where hardware sales were simply the means to deploy a software platform. The problem was simple. That future required the technology to work flawlessly, and it didn't. Not yet. The crash reports told a different story than the stock price. 7 accidents had occurred in recent months involving the Austin Robotaxi fleet. Not all were Tesla's fault. Human drivers caused some collisions, but the incidents triggered federal scrutiny. The National Highway Traffic Safety Administration opened investigations into Tesla's safety protocols and data reporting practices. Questions emerged about whether the company was fully transparent about incidents, whether safety metrics were being accurately reported, whether the rush to scale was compromising caution. In October 2025 crash involving a Robotaxi prototype intensified regulatory pressure. Details were scarce. Tesla's data redaction practices made independent analysis difficult, but the incident raised uncomfortable questions. If autonomous systems failed in controlled testing with safety drivers present, what would happen when those safety nets were removed? Critics pointed to fundamental technical differences. Waymo's approach relied on LiDAR, radar, and multiple sensor redundancies. Their vehicles cost significantly more to produce, but the sensor-heavy system provided layers of fail-safes. When one system failed, others compensated. Waymo's safety record reflected this philosophy. 500,000 miles between collisions, a figure approaching and potentially exceeding human driver safety rates. Tesla's vision-only approach was cheaper to scale. Cameras and neural networks trained on millions of miles of real-world data. No expensive LiDAR arrays. Lower production costs meant faster fleet expansion, but it also meant fewer redundancies. When the AI misinterpreted a scene, glare from sunlight, unexpected construction zones, unusual weather conditions, there were no backup sensors to catch the error. The bet was elegant in its simplicity. Solve vision, solve autonomy. Inside Tesla's AI team, the confidence was palpable. They'd built an end-to-end neural network processing over 10 million miles of driving data daily. The system was learning at a rate competitors couldn't match. Every Tesla on the road contributed to the collective intelligence. While Waymo operated thousands of vehicles in controlled environments, Tesla had over 1 million cars feeding data from every conceivable driving scenario. The technology had reached what internal teams called near Level 4 autonomy. Not perfect, but operational in most conditions. The question wasn't whether the system would improve. Everyone agreed it would continue advancing. The question was whether it was ready now for unsupervised deployment at scale. He made the decision knowing it wasn't ready for all conditions. But waiting for perfection meant waiting forever. And waiting meant losing to Waymo, losing to Chinese competitors developing their own autonomous systems, losing the first-mover advantage in markets that would likely consolidate around 1 or 2 dominant platforms. The financial pressure demanded speed over caution. Tesla's core automotive business was struggling. Third quarter 2025 vehicle revenue grew only 5.9% year-over-year. 9-month cumulative data showed a 9.5% contraction driven by aggressive price cuts and trade policy uncertainties. Operating income had dropped 40% year-over-year to $1.6 billion. The company was sacrificing short-term automotive profits to fund the autonomous future. This trade-off only made sense if the Robotaxi timeline held. Delays would expose the company to a valuation reckoning. Stock analysts valuing Tesla at $3 trillion were pricing in Robotaxi revenues that didn't yet exist. If those revenues materialized by 2030, the valuation made sense. If they didn't, the stock was overvalued by 170%, according to traditional discounted cash flow models. He understood this arithmetic perfectly. The Robotaxi announcement wasn't just about technology readiness, it was about maintaining investor confidence that the timeline was achievable, that the vision was becoming reality, that the gap between promise and delivery was closing. But every accident now carried exponential consequences. A single fatal crash involving an unsupervised Tesla Robotaxi wouldn't just trigger lawsuits and regulatory investigations, it would shatter the narrative holding up the stock price. Investors betting on autonomous future would suddenly confront the reality of imperfect technology deployed prematurely. The Musk premium, the valuation buffer based on his track record of achieving seemingly impossible goals, could evaporate overnight.
Safety engineers understood the stakes.
They'd pushed for more conservative rollout timelines,
Additional testing in controlled environments, graduated expansions that proved safety before scaling. Management understood a different equation. Controlled rollouts meant slower progress, which meant falling behind Waymo's expanding lead, which meant losing the autonomous vehicle race to a competitor with deeper pockets and more patient investors. The conference rooms where these decisions were made weren't filled with reckless optimists. They were occupied by people running complex risk calculations, weighing probabilities of accidents against probabilities of market capture, balancing engineering caution against competitive urgency. In those late-night planning sessions, someone would inevitably raise the uncomfortable question, what if someone dies? The response was never dismissive, it was statistical. Human drivers killed approximately 1.35 people per 100 million miles driven in the United States. If Tesla's system could match that rate, it was ethically neutral. If it could beat it, deployment saved lives overall, even if individual tragedies occurred. This was the utilitarian calculus that justified removing safety drivers. But public perception didn't operate on utilitarian principles. A death caused by autonomous technology would generate fundamentally different reactions than deaths caused by human error, regardless of comparative statistics. People feared what they didn't control, what they didn't understand. A robot making a fatal mistake felt qualitatively different than a human making the same mistake, even if the outcomes were identical. Tesla's internal polling showed 87% of consumers expressed willingness to use autonomous vehicles, with 70% preferring them to human drivers. But those numbers were collected before widespread deployment, before the first major incidents, before the technology moved from abstract future to concrete present. The Austin rollout was a live test of whether confidence would survive contact with reality. The initial service area covered 38 square miles, not the entire city, but enough to demonstrate capability. Employees received first access through a controlled release of the mobile app. Early reports were overwhelmingly positive. Riders posted videos of smooth trips, successful navigation through complex intersections, competent handling of unexpected situations. But the positive coverage obscured the underlying fragility. The service area was carefully selected. Routes were predominantly wide streets with clear lane markings, minimal construction, and relatively predictable traffic patterns. Weather conditions were favorable. Texas in winter meant mostly clear skies, none of the snow or heavy rain that confounded vision systems. These weren't the full range of conditions vehicles would encounter in nationwide deployment. They were optimized scenarios designed to demonstrate capability while minimizing failure risk. It was strategic staging, which was sensible, but it also meant current success didn't predict performance in more challenging environments. He knew this, the team knew this, but public messaging emphasized capability over caveats. Press releases highlighted successful trips and growing service areas. They didn't detail the geo-fenced boundaries where the system still required human oversight, the weather conditions where autonomous operation was suspended, the edge cases where intervention was still needed. This gap between public narrative and operational reality was widening. Competitor analysis from Waymo suggested a different approach. Their expansion was methodical, almost painfully gradual, 7 years of commercial operations before significant scaling. But that patience had built a safety record that regulators and consumers trusted. Tesla's approach was the inverse: scale quickly, prove safety through volume, except that some failures would occur during the learning process.
Neither strategy was inherently wrong. They reflected different philosophies about risk, different timelines for profitability, different competitive positions. Waymo had Alphabet's resources behind them and could afford patience. Tesla needed robotaxi revenue to justify its automotive valuation and couldn't afford delay. The question markets were beginning to ask, was Tesla moving fast toward success or fast toward disaster? Autonomous vehicle experts interviewed by research firms expressed mixed views. Some praised Tesla's vision-only data scale and vertical integration. The flywheel effect was real. More vehicles meant better AI, meant more capability, meant more vehicles. Others worried about sensor redundancy and edge case handling. Vision-only systems were elegant but potentially fragile when encountering scenarios absent from training data. Dr. Priya Narayan, an autonomous vehicle researcher at Stanford, noted the uncertainty. Tesla's vision-only approach is technically elegant but unproven at scale. Edge cases, snow, glare, construction zones could still confound pure vision models. Michael Chen, a former Waymo engineer, emphasized the safety advantages of sensor redundancy. We respect Tesla's data scale, but safety demands sensor redundancy. Waymo's robotaxis have completed over 20 million miles of fully driverless service with zero at-fault collisions. The technical debate was really about acceptable risk thresholds. Tesla's position was that camera-based systems, given sufficient training data, could match or exceed human perception. Humans drove with only vision and cognitive processing, no LiDAR, no radar. If AI could replicate human visual processing at scale, adding expensive sensors was redundant. The bet was on neural networks, not hardware. Critics argued humans had evolved perceptual systems over millions of years with wetware processing that current AI couldn't replicate. Edge case handling, the ability to recognize and respond appropriately to situations never previously encountered, remained a fundamental challenge. Humans handled novel situations through reasoning and intuition. AI handled them through pattern matching against training data. When situations fell outside the training distribution, AI behavior became unpredictable. This wasn't theoretical concern, it was the core safety question. How would the system respond to scenarios it hadn't seen before? Waymo's answer was sensor redundancy and conservative operating parameters. Tesla's answer was more data and faster iteration. Time would reveal which approach was correct. Meanwhile, the financial clock was ticking. Investment analysts were beginning to separate bullish predictions from realistic assessments. Wedbush maintained aggressive price targets, suggesting Tesla's AI and robotics initiatives could independently be valued at $1 trillion. Morgan Stanley was more cautious, downgrading the stock due to execution risks, noting that long-term projections lacked tangible revenue proof. The divergence reflected fundamental uncertainty. Tesla was either transitioning from hardware manufacturer to AI platform, a transformation worth trillions, or it was a car company with declining margins and speculative autonomous projects. Both narratives had supporting evidence. Which one was true wouldn't be clear for years. He'd navigated these credibility gaps before. SpaceX was called impossible until it wasn't. Electric vehicles were called impractical until they weren't. The pattern was familiar: aggressive timelines, skeptical experts, eventual success. But past performance didn't guarantee future results, and autonomous vehicles posed challenges qualitatively different from rockets or electric powertrains. Rockets exploded during testing. Electric vehicles had range limitations, but failed autonomous systems killed bystanders. The asymmetry of consequences changed the risk calculation fundamentally. December 2025 became the inflection point.
The announcement of unsupervised operations in Austin triggered market euphoria. Stock jumped. Analysts released bullish notes. Competitors accelerated their timelines in response. But beneath the excitement was a brittle foundation. One major incident would fracture everything. He understood this better than anyone. The entire strategy was a calculated gamble that technology would improve faster than incidents accumulated, that public perception would embrace autonomy before a tragedy destroyed confidence. that regulatory approval would come before political pressure shut down testing. It was a race against probability. Every mile driven without incident increased confidence. Every successful trip validated the approach, but probability was undefeated. At sufficient scale, unlikely events became inevitable. The question wasn't whether an incident would occur. The question was when, and whether the technology would be mature enough by then to survive the scrutiny. Late at night, in quiet moments between meetings, he sometimes wondered if they were moving too fast, if the competitive pressure was forcing decisions that risk assessment alone wouldn't support, if the stock price expectations had created a trap where caution meant failure and aggression meant danger. But morning always came, and with it the conviction that waiting was the greater risk. Markets rewarded speed. Competitors were advancing. The technology was improving daily. Every week of delay was a week Waymo extended their lead. A week Chinese companies closed the gap. A week regulators might impose restrictions that would lock in current leaders. The decision to remove safety drivers wasn't reckless. It was strategic risk acceptance, calculated, deliberate, based on imperfect information and competitive necessity. Whether it was correct wouldn't be known until long after the decision was made. The Austin streets now carried vehicles with empty driver seats, neural networks making split-second decisions, algorithms interpreting scenes that determined whether passengers arrived safely or not. Each trip was a test. Each successful journey built confidence. Each mile without incident pushed the technology further toward acceptance. And somewhere in those millions of miles of future driving, an edge case was waiting. A scenario the AI hadn't seen, a situation where probabilities aligned wrong, a moment where machine perception failed. The question wasn't if that moment would occur. The question was when, and whether the technology would be mature enough by then to survive the scrutiny.